Welcome to a deep exploration of the most important financial lesson ever recorded. Today we travel back to the electric and optimistic year of 1929. This was a time when opportunity felt endless and wealth seemed guaranteed. Every day people believed financial success was finally available to everyone. Stock prices climbed steadily and confidence rose even faster across the nation. Many believed the market had discovered a permanent path toward prosperity. Conversations everywhere centered around easy profits and rapid financial growth. People discussed stock prices the same way they discussed weather forecasts. Optimism filled newspapers, cafes, offices, and family dinner tables alike. The decade earned the name Roaring Twenties because energy seemed unstoppable. New inventions transformed daily life and strengthened confidence in progress. Radios brought information, entertainment, and advertising directly into living rooms. Automobiles reshaped cities, jobs, and personal freedom for millions of Americans. Factories expanded rapidly and productivity increased at historic speeds. Corporate profits surged, and investors believed growth would never slow. Many assumed modern economics had eliminated serious downturns permanently. That belief would soon prove dangerously incorrect for countless families. Behind the celebration, a fragile structure quietly supported the entire system. This structure relied heavily on borrowed money and unchecked speculation. Few people stopped to question whether prices reflected true business value. The market slowly inflated into something far larger than fundamentals supported. Small warning signs appeared but were ignored by most investors. Rising debt levels were dismissed as innovation rather than risk. Confidence became the strongest force driving financial decisions. When confidence rules, markets' caution quietly disappears. The first critical lesson begins with understanding borrowed investment money. In 1929, investors could buy stocks using only 10% cash. The remaining 90% came from loans provided by brokers. This method allowed people with little money to control large positions. At first, the strategy felt brilliant and highly rewarding. A 10% stock increase doubled an investor's original cash. Success stories spread quickly and encouraged even more participation. Few considered what would happen if prices moved downward instead. Borrowed money magnifies gains, but also multiplies losses brutally. Even a small price decline could erase an entire account instantly. Many investors underestimated how fast losses could accumulate. Margin calls forced people to sell at the worst possible moments. Accounts vanished before investors fully understood what happened. Life savings disappeared within hours during volatile trading days. Families watched decades of effort dissolve without warning. This devastation stemmed from risking money that was never truly owned. The first rule is simple and timeless for every investor. Never invest money that you cannot afford to lose completely. Leverage behaves like fire when handled carelessly. One small spark can destroy years of careful construction. Borrowing to invest creates fragile financial foundations. Strong markets can hide that fragility temporarily. Eventually, reality always exposes excessive risk. History repeatedly confirms this pattern across generations. Debt reduces flexibility when markets move unexpectedly. Low debt provides resilience during uncertain economic periods. Investors who avoided leverage survived downturns far better. Those who relied heavily on borrowing suffered the most damage. Responsible investing always prioritizes survival over excitement. The second rule addresses the danger of blindly following crowds. In 1929, popular stocks dominated everyday conversation. Investment tips came from neighbors, relatives, and casual acquaintances. Even people without financial knowledge confidently offered advice. Stock discussions became social proof rather than analysis. Joseph Kennedy famously recognized a dangerous signal. He noticed shoeshine boys offering enthusiastic stock recommendations. That moment suggested speculation had reached extreme levels. When everyone buys without understanding risk, danger increases. Crowd behavior often peaks right before major downturns. Markets reward independent thinking, not blind imitation. Following others feels safe but often leads to shared losses. True investing requires personal responsibility and careful research. Popularity does not equal value in financial markets. Most people arrive late after prices already reflect optimism. The crowd usually reacts rather than anticipates change. Successful investors step away when excitement overwhelms logic. Independent analysis protects against emotional market extremes. If an opportunity sounds effortless, skepticism is essential. Reality rarely delivers easy wealth repeatedly. The third rule focuses on diversification and risk spreading. Many investors in 1929 concentrated everything into single sectors. Technology stocks attracted massive attention and heavy investment. Radio companies symbolized innovation and future potential. Automobile manufacturers represented growth and modern progress. These sectors performed brilliantly until momentum reversed suddenly. When prices fell, concentrated investors suffered devastating losses. Owning only one type of asset increases vulnerability. Diversification reduces exposure to any single economic shock. Different assets respond differently to changing conditions. Some decline while others remain stable or recover faster. This balance smooths long-term portfolio performance. Diversification does not eliminate risk but controls its impact. It allows investors to endure difficult periods calmly. Spreading investments across sectors protects purchasing power. Cash, bonds, and commodities add further stability. A balanced portfolio improves emotional decision-making. Better sleep often follows well-diversified investments. Many 1929 investors lacked defensive assets entirely. They held no reserves to weather declining markets. Diversification would have preserved options and flexibility.